What type of retirement accounts are there? Does the difference between them determine how they're treated for purposes of equitable distribution? Do the differences between the accounts influence what kind of documents we need in discovery in order to address those accounts? Does it make a difference on the accounts with regard to survivor benefits and future income? Those are the questions we're going to talk about in this session. I'm Michael Miller. I'm a partner at Cole Miller PLLC. We're a family law firm located in Vienna, Virginia, serving primarily in the Northern Virginia area. I analyze challenges and I find affordable solutions for families and their family law needs. So the issue of issue of retirement accounts, is very broad. Lots of books written on it. Entire hours can be discussed on the various aspects of retirement accounts. But in this video and the next one, I want to talk about kind of a broad classification of how retirement accounts get divided up. The first broad area is what's called a defined contribution account. And the second area that we'll talk about in the next video is what's called a defined benefit account. Defined contribution accounts are accounts that you put a defined contribution into, hence the name, and their current cash value. So examples would be 401k accounts or 403b accounts, where each payday, each payroll, you put in set aside a certain amount to be deposited to that account. These would be similar to the thrift savings plan accounts that the federal employees have, and other related accounts like that, where you're taking a certain dollar amount each payroll or periodically and depositing to that account. Similar to this is an IRA account. It is a present cash value account. It's not necessarily a defined contribution because you can vary when the money's deposited to the IRA. It's not coming out of payroll. It's something that you're doing yourself. And for defined contribution accounts, having the statements to show what the balance was on the date of marriage, what the balance is on the date of separation, and then having statements for the date of trial or current valuation are all critical. And even having the interim statements, the periodic statements in between, can be helpful, because what has to be done at some point, as we talked about in our one of our initial videos on the 5 topics of divorce, is this account you have to look at when it was established. If it was established before the marriage, it's presumed to be separate. And so the other spouse is going to want to trace the marital contributions and the growth and interest on that to establish a marital asset that's subject to division. Likewise, for the spouse that owns the account, if it was established during the marriage, it's presumed to be marital, but they will want to trace out post-separation contributions to minimize how much of that asset has to be shared with the other spouse. Again, as we talked about with title, the retirement accounts will be titled in one person's name, but title only determines what the judge can do with the account, not how the account gets classified as marital or separate, or whether it can be divided. So it will be in one spouse's name, but it could still have a marital interest there. And so when you're valuing these accounts, it's going to be important to come to an agreement or to try to establish, for instance, what the date of separation is. The date of separation is the event that terminates the marital interest. And so all contributions to the 401k plan prior to the date of separation would be marital, subject to division. After the date of separation, separate, not subject to division. And so especially, we'll talk about in the next one with regard to the pensions, is trying to establish that date of separation can impact as to what portions are marital and what portions are separate. Because a defined contribution account is a present value cash account that gets divided, and so you determine what the marital portion is, that gets divided between the spouses. There is no survivor annuity or any kind of concern about what happens to the money upon the death of the other spouse, because there's $100,000 in the 401k account. You split that 50-50. Each spouse gets their $50,000 and they go on about life. If one of them were to predecease, the other spouse has no impact because the surviving spouse still has their $50,000 for their retirement needs. It is a division of property, so this isn't something like spousal support that could be modified or subject to review at some point in the future. So it's kind of a one and done proposition. And so that's kind of the nature of the defined contribution plan. It's a present value account that has to be valued and then classified as marital and separate. There are anti-alienation laws that apply to these accounts. So basically what you find is that if you try to take money out of the accounts before specified age, you're subject to early withdrawal penalties. Also, because they are pre-tax contributions, there is a tax liability that comes with that. So if you're doing a property settlement and you're offered $100,000 of house equity or $100,000 of 401k money, you're better off with the house equity because it would come to you tax-free and without early withdrawal penalties. So that's $100,000 you can use immediately. Whereas if you took the $100,000 of 401k money, it does, come with the early withdrawal penalties, the tax consequences. Now, there are some ways that you could, discount that $100,000 of retirement money to make it equivalent to non-retirement money. But for the most part, when we're doing settlements, we do all the non-retirement accounts together, and then we do the retirement accounts separately. Also, to access these accounts, as I mentioned with the anti-alienation laws, they're protected from creditors. The businesses can't use them and carry them on their spreadsheets as assets of the business and so forth. And so they're very locked down and inaccessible. But what you have to do is you prepare what's called a qualified domestic relations order. Some people call it a quadro, other people call it a quadro. But that's one of the exceptions, is that allows you to transfer money out of that account without triggering penalties or taxes on that. And to further avoid that, you should do a custodian to custodian transfer, because if you take the money out of the 401k on a way over to your rollover IRA, it could be subject to withholdings and so forth. You may be able to file to get those back, but the custodian to custodian is the cleanest and least troublesome way to accomplish that. So that's kind of our quick overview on a defined contribution account. It's a present value plan. You value it, you divide it, prepare a court order to transfer the money from the account holder to their recipient spouse incident to divorce.